So today I'm going to talk about a stock I have never talked about on the YouTube channel before. It's a stock that IPO'd in 2021 and this stock is down 70% since its IPO. And yesterday, this stock actually crashed 30%. So we're going to see if this is an opportunity that's worth buying. And also what's quite interesting about this stock, it's also a dividend stock. So we'll take a look at this one. So this is a UK company called Martens. I'm sure most of you guys will know of this brand. And you can see yesterday, the stock closed down 30%, and you can see the trading update that came out and caused the drop, and as the day went on the stock just went lower and lower and lower. So it's been a bit of a brutal time. Now today I was wondering if we're going to see a little bit of a bounce in Martens. It's not happening though. It's actually fallen another 3%. It was actually at 4% at one point, so it carries on its drop. It was a company that it was actually founded in 1945, so it's definitely not a new company at all. It's a 1.3 billion market cap company trading at 7 times earnings and paying at the moment a 2.2% dividend yield, but we're actually going to talk about that dividend because it's actually going to potentially be a little bit higher than what Google is showing right now. And if we actually zoom out to the IPO, you can see here it came on the stock market in 2021, one of the 2021 IPOs, and it's had a really tough time since then. But I mean, look at the IPOs, especially on the UK market. I mean, nearly all the IPOs that I can think of in 2021 are down massively. You look at the likes of Deliveroo, for example. Darktrace was a 2021 IPO. I'm sure that's down massively as well. So it's been a bit of a brutal time for a lot of these IPOs. And yeah, crazy to think it came on the market at £4.50 and now it's £1.39. So it's had a bit of a tough time since its 3.7 billion market cap IPO. Now, obviously, Martens, I'm sure most of you guys know these or know of this brand and have seen the stores wherever you've been out shopping. Obviously, a producer of shoes or boots, do them for women, men, kids. They also do a couple of accessories as well, but most of their income comes from the shoes. They have their originals and they do some collaborations now. And some of their income comes from the actual retail stores that they also have their online presence, and also they make some of their money through wholesale as well. Now I'm sure many of you are aware this is a bit more of a higher end luxury good. So obviously just going on to some boots here for men, for example, you can see £159. Most of these are all £159 up to £179. So they're a little bit of a higher end luxury good. So this obviously has very good margins, very good profit margins. If we just have a quick look onto what they've done previously, you'll be able to see that the profit margins are around 18%, which obviously you would expect when you're selling your product for over £100. And when you look at the gross margins are 63%, so very high gross margins on this product, as you can see here. Now, automatically, when you do think of the product here and the gross margins, obviously, one thing when you get involved in this space like a Dr. Martens is that obviously it's a fashion brand. So one of the concerns you always have with a fashion brand is, could this potentially go out of trend? And it can happen all the time. Now, obviously, Martens is a bit more of a proven brand because obviously they were founded in 1945 and obviously it's 2023 now. So through that length of time, they have proven to be a resilient fashion brand. But there's always that worry that there's times where the fashion or the appeal is very high and then very low, and it definitely seems like they're going through one of their more higher peaks at the moment. I think a lot of people are wearing Martens when you do look around, but there's always that worry, could there potentially be a little bit of a cool down, which has that little bit of a risk. And also, I guess when you are a higher end luxury product at £159 and we are entering into a bit of a higher recession environment or a bit of a cost of living crisis, potentially will people go and spend as much on potentially a pair of £160 boots or shoes? And there's that little bit of worry at the moment with the environment that we are in. But like I said, the good thing or the resilient thing that you have about Martens is it's proven historically to be a brand that sits around and has been doing very well over the years. But I guess that's always a risk with this kind of space here. So what's causing this drop in Martens at the moment? Well, if we go onto the recent trading update, this was the main cause of the 30% drop that we had yesterday, the 19th of January. So you can see here that they said that they have been doing well through a challenging conditions, but they said there has been operation issues which created a bottleneck in their new LA distribution center and weaker than anticipated US DTC trading, in part to unseasonably warm weather. We now expect full year revenue growth of 11 to 13% on an actual currency basis and full year EBITDA to be between 250 to 260 million. So there's a few things to kind of go through there. Obviously, they're blaming a bottleneck and obviously some issues with the products and getting them out there. Now, because it is a new LA distribution center where this issue was at, I can see that happening. You know, when you get a new distribution center, everyone's a bit like, oh, where does this go? Or what's the routine or the process for things going in different places? You can sometimes get that with new distribution centers. So I can understand that or something like that happening. So clearly they have a bit of a warehouse issue there. One part I didn't like about this US here is that they said that also parts are due to unseasonably warm weather. I don't really like it when companies blame weather for issues of sales. I think I remember 2 years ago, ASOS was a company that came out and said, it rained a little bit too much, so our sales were weak. And it was like, you can't say that your sales are weak because it rained a little bit too much. I think it was in like the month of June. They said, I think they actually identified the month of June as a very rainy month, and it was like, come on. And actually from there, it actually turned out it was more than it rained. There was a bit more of a sales issue going on with ASOS, as many of you guys might recognise a little bit now. I'm not a big fan of blaming the weather for weaker sales. So this is a little bit worrying to me. I think this is kind of, we've got weaker demand. What can we blame it on? The weather. So this is what I mean about being a fashionable industry, is that out of nowhere you could see your brand go very much in popularity, and you can see that popularity decline very quickly as well. So it seems to me that was a bit of a worrying concern that you had there in that trading update, but I can understand the bottleneck issues that did cause some problems inside the company. Now, when you do look at the company here, the Q3 was 3% and the year-to-date was 5% on a revenue basis. Now, obviously, the key thing is this is slowing down. 3% compared to 5% is obviously a slowdown, and I like going off constant currency as well. I know you could say it was 9% and 12%, but I think that's a lot better reflection. And that's the big thing with Doc Martens at the moment, is you can see here, historically, this brand has been growing rapid amounts of growth here. So looking at this here, even when you consider that there was the bottleneck issue, Doc Martens is now definitely growing at a slower rate than what it has done previously, as you can see here. And that is obviously what is probably causing, even not just from yesterday, but the longer term drop in from 2021 down to where we are in 2023, is previously when you were going into 2021, you had very good amounts of revenue growth, and that revenue growth is starting to just slow down a little bit here, which is something that obviously if you're growing slower, you're going to command a lower valuation. And also you've got to think, okay, is this brand starting to go a little bit out of popularity? But obviously we're still growing in a good direction, which is positive. Retail was 16%, D2C was 6%, and wholesale did decline 1%. Now, the wholesale was very clear because they did say it was to do with the LA distribution center, and you can see that is now going to reduce financial year 23 EBITDA by 16 to 25 million, depending on the pace at what this issue is resolved. And they said the reasons why it was caused, and then they also said potentially how they are going to improve this. But it did say that it is limiting its capacity to meet wholesale demand and our Q4 shipment forecast. So this is clear that potentially this is obviously Q3 and there's issues here, but we could actually see this go into Q4 as well. In financial year 23, we estimated that the bottleneck will reduce our wholesale revenue by 15 to 25 million and EBITDA by 16 to 25 million. So you can see it would have actually been potentially a bit of a higher growth year, which is positive if it wasn't for this issue. And obviously we've seen profit dropping as well, including 8 to 11 million of supply chain costs, which is probably because they had to get a little bit more warehouse storage with some of the issues that they had. We expect there to be knock-on effects from the financial 23 distribution into financial year 24, but we anticipate these should normalise in H1 24. So they're saying here that obviously moving into 24, some of these issues will continue, but by the first part of the year, it should be over. So we could see these issues still pop up in the next kind of 6 months really. Now I was wondering if they were going to give any sort of forecast going into the future for financial year 2024, but there was not much commentary on numbers. The only statement is the knock-on effect from the LA distribution center issues and more uncertain economic environment. That's a little bit of saying to me that they are seeing a little bit of revenue slowdown, are likely to impact the financial year 24 revenue growth. In addition, we have been reviewing the strategic and economic benefits of continuing to sell into pure play wholesale e-commerce accounts, e-tailers, particularly in EMEA, and as a result, we have therefore decided to reduce volume into these accounts in financial year 24. Over time, the benefit will be to underpin DTC mix expansion, but in financial year 24, revenue growth will be impacted, and these factors together lead us to believe financial year 24 revenue will be mid to high single digits on a constant currency basis. So we kind of got some information there, and if they did come in financial year 24 revenue growth in mid to high single digits, that would actually not be too bad. It'd be somewhere where we're seeing them roughly obviously around now, but what is obviously key, which we said earlier, is the growth is slowing down. Now at the moment, Doc Martens does trade at 8.2 times earnings, and if we do compare that to some competitors, for example, you got JD Sports, which trades at 24. Now obviously that's a company that's absolutely flying. You got Shoe Zone, which is a bit more towards similar growth, does trade at 11 times earnings. Superdry and Ted Baker doesn't have a PE. Superdry is 5.3. But obviously they've had bankruptcy issues. So really the only one we can kind of compare it to is something like a Shoe Zone. But as you can see here, Shoe Zone is a lot flatter on the revenue. It also doesn't have the profit increasing as well kind of going on. It also has very thin margins, but it does pay a dividend here. But you can see here, Shoe Zone is nowhere near the quality of Doc Martens. So compared to the competitors that we had, we could argue that Doc Martens should be a little bit higher on a P basis compared to some of the competitors. When we look at the past growth, it has been fantastic, as you can see here from the revenue and profit. The only issue now is that we are expecting that to slow down slightly going forward. And analysts are forecasting 10% revenue growth. Obviously, they've got to update their forecast where it's a little bit slower in that mid to high single digits. So there's a little bit below analyst expectations going on there. Obviously there's some impact on the profit, as you can see here, because of them supply chain issues, but if they can resolve them and we move into 2025 with high single digits growth and then a profit issue resolved, obviously we could see higher profit, which would be fantastic. And when we look at the balance sheet, it did used to be a bit of a bad looking balance sheet, but it has got slightly better. 84% debt to equity, 292 million debt on the balance sheet there. They do sit on 133 million cash, so the balance sheet could be a little bit stronger than what it is right now, but it's not terrible, but just could be better. Now the interesting point is the dividend. So at the moment you'll be able to see that Google says that the dividend is actually 2.2%. But actually when we dig into the potential dividend, it's actually more than likely going to be around a 4% dividend yield. The reason why is because at the moment it is quite hiking up its dividend. So it just announced its dividend, which is going to be way above the forecasted amount. And potentially if we see the final dividend way above the forecasted amount as well, I think they increased their interim dividend just by 30%. Recently, we could actually see Doc Martens around a 4% dividend yield at the moment, which would obviously be really positive. Now, going into the ownership, there's only been one buy from the lead director. So with this big massive drop off in Doc Martens, I'd be very interested to see some insiders buying up. I think that would give you a lot of confidence if you see some insiders buying up after this dip. So that would be something that I would be staring at, because obviously they'll be they've got better information than anyone. So if there is some sales problem, you'd be like, okay, why are they not picking up some shares? But if they're like, you know what, this share price is overdone, the company's still doing very well, we're going to pick up some shares. That gives you so much more confidence. We've seen that with the likes of like Catebox, for example. If you remember, the CEO came in and bought shares straight after the drop, and you're like, okay, that's a really positive sign. And then we got the recent trading update, and he was like, yeah, things have gone back to how they were. It was just a blip, and that gives you so much confidence. And the reason why he bought shares is that obviously he could see it was some form of a blip. It just gives you so much confidence. So that's something that I would be staring at if I was interested into Doc Martens. But overall, my thoughts are that it is an area that concerns me because it is very dependent on if it is popular at the time with sales. However, you are getting a very good clothing brand here. And when you do look at the company, they have been performing very well financially previously. Going forward, if they do resolve this bottleneck issue and they do continue to grow at 5, 6, 7% revenue growth, and you are also picking up a 4% dividend, I've got to say this is actually quite interesting, especially if you're picking this up somewhere between 7 times earnings at the moment. So my thoughts is that I am actually quite interested in this one. The only problem I have is I don't know if it's a good fit for my portfolio because I've already got ASOS, Boohoo and JD Sports in there. 3 fashion stocks already, which I don't know if it's a good fit for me, which I've got to personally work out. But if I didn't have them stocks and I was staring at this one at 7 times earnings, potentially a 4% dividend yield, growing still at 5, 6, 7% revenue growth, potentially this sort that bottleneck out, and then we see the profitability come back in a year's time. I think it could be a really interesting one. I think at some point some bottom pickers will come in and try buy this stock up and see it go up a value. At the same time, I could see the stock maybe downtrending another 10-20% at the moment while these issues carry on. Potentially if we get an update and those issues at that distribution centre have got worse, maybe we see that stock drag down maybe another 10-20%. Maybe we see that the stock drag down into a 7, into a 6 times earnings. If that happens, I think that's really interesting. I think if you start seeing this stock getting dragged down into that 6 times earnings, I definitely start thinking when you start thinking about risk to reward, I definitely think it comes really interesting at them sort of levels, considering as well the dividend yield you'd pick up on that one. So yeah, for me, it's one that I'm watching for sure, and I'm going to keep on a watch list. And I think if you do get a bit more pain in the share price and it goes down that little bit more, I think this definitely comes quite interesting for sure. So hope you enjoyed the video anyway, guys. If you could hit that like button, let me know what you think of this one in the comment section. Let me know if you're a buyer at the moment on this very aggressive dip that is happening at the moment. And yeah, catch you in a bit. Have a great weekend.